The most catastrophic disruptions to global financial markets rarely emerge through gradual portfolio adjustments or predictable investment cycles, but through instant divestment decisions that expose how thoroughly international capital markets, institutional investment stability, and retirement security depend on capital flows that entire financial systems have assumed would continue indefinitely. Regardless of how investment relationships are managed, or whether financial partnerships serve mutual benefit rather than unilateral capital extraction from partners whose investment sovereignty they never seriously considered. 1 minute ago, major Canadian pension funds, including Canada Pension Plan Investment Board, Ontario Teachers' Pension Plan, and Public Sector Pension Investment Board, implemented coordinated divestment of $120 billion in United States assets, forcing immediate market suspension across multiple exchanges while triggering algorithmic trading. Panic that exceeds $300 billion in market capitalization losses as American financial institutions face systematic capital withdrawal that investment planning had assumed would remain stable regardless of diplomatic relationship quality. This isn't investment protectionism or hostile financial warfare. This is the ultimate assertion of investment sovereignty that exposes how completely American capital market strategy has failed to account for institutional dependencies that can eliminate market liquidity instantly when cooperative relationships deteriorate beyond the point where continued investment accommodation serves Canadian retirement security more than American financial market convenience that had taken Canadian capital for granted without ensuring reciprocal benefits or respectful partnership maintenance. What just happened represents the most dramatic assertion of investment sovereignty in modern financial history. A coordinated withdrawal of institutional capital that affects the foundation of American equity markets, threatens retirement system stability, and reveals the systematic nature of American financial vulnerability when investment relationships that sustain market capitalization suddenly become conditional on diplomatic cooperation that American financial policy apparently never seriously considered as factors requiring careful management rather than assumed accommodation with American capital market requirements. The immediate impact affects major American stock exchanges, where Canadian pension fund divestment eliminates market-making capacity, reduces trading liquidity, and forces emergency circuit breaker activation. When algorithmic trading systems recognize systematic capital withdrawal that market stability mechanisms cannot absorb without triggering cascade selling. New York Stock Exchange, NASDAQ, and Chicago Mercantile Exchange face simultaneous trading suspension when Canadian institutional selling overwhelms market capacity. Canada Pension Plan Investment Board, managing over $500 billion in retirement assets, announced immediate liquidation of $45 billion in American equity holdings, including major positions in Apple, Microsoft, Amazon, and Google, while redirecting investment toward European, Asian, and domestic Canadian opportunities that serve Canadian retirement security, rather than accommodating American financial market preferences that might conflict with fiduciary obligations to Canadian EIN beneficiaries. Ontario Teachers' Pension Plan, representing over 200,000 active and retired educators, implemented emergency divestment of $35 billion in American financial assets, including bank stocks, real estate investment trusts, and technology companies, while establishing alternative investment partnerships with European pension funds and Asian sovereign wealth funds that offer superior returns with geopolitical stability guarantees. Public Sector Pension Investment Board coordinated withdrawal of $2 billion from American infrastructure investments, energy projects, and municipal bonds while redirecting capital toward Canadian infrastructure development and international partnerships that serve Canadian public sector retirement security without requiring accommodation with American investment preferences that might subordinate Canadian pension obligations to external market accommodation. Castapoo A+ Quebec terminated $15 billion in American private equity partnerships, hedge fund investments, and venture capital commitments while establishing French-language investment cooperation with European institutional investors that respect Quebec's cultural sovereignty while providing competitive returns that serve Quebec pension obligations without American market dependency. The market meltdown. Implications reveal how Canadian investment sovereignty affects global financial stability, institutional investor confidence, and capital market functionality. When major pension fund withdrawal eliminates the patient capital that equity markets depend on for stability during volatile trading conditions, American retirement systems face immediate pressure when Canadian divestment triggers recognition of similar vulnerability among domestic institutional investors. Dow Jones Industrial Average experienced immediate decline, exceeding 3,200 points when Canadian pension fund selling triggered algorithmic trading systems designed to prevent market manipulation, but unable to distinguish between legitimate institutional divestment and coordinated market attacks. Circuit breakers activated 3 times within the first hour as trading volumes exceeded exchange capacity for processing institutional order flow. Nasdaq Composite Index collapsed over 18% when technology stocks faced concentrated selling pressure from Canadian pension funds that had maintained significant positions in American innovation companies. Apple lost over $200 billion in market capitalization when Ontario Teachers' Pension Plan liquidated its entire position while announcing investment redirection toward European technology partnerships. S&P 500 experienced systematic decline when financial sector stocks faced particular pressure from Canadian pension fund investment of banking, insurance, and investment management companies. J.P. Morgan Chase, Bank of America, and Goldman Sachs collectively lost over $150 billion in market value when Canadian institutional investors eliminated exposure to American financial institutions. Cryptocurrency markets experienced immediate volatility when Canadian pension fund divestment included digital asset holdings and blockchain investment partnerships, while pension funds announced exclusive focus on central bank digital currency development and sovereign cryptocurrency initiatives that serve Canadian monetary sovereignty rather than accommodation with American digital finance preferences. The retirement security implications demonstrate how Canadian pension fund sovereignty affects American retirement system stability, Social Security sustainability, and individual retirement account performance when institutional investment withdrawal eliminates the capital flows that American retirement security depends on for maintaining asset values and generating returns that retiree income requirements depend on for financial stability. Social Security trust fund investments face immediate pressure when Canadian divestment affects Treasury bond markets that Social Security surplus funds depend on for generating returns. Federal retirement obligations require stable capital markets that Canadian institutional withdrawal affects through reduced liquidity and increased volatility that government retirement promises depend on for financial sustainability. 401k retirement accounts experience immediate value decline when stock market collapse affects individual retirement savings that American workers depend on for retirement security. Pension fund divestment triggers recognition that American retirement wealth depends on international capital flows that diplomatic relationship deterioration can eliminate through legitimate investment sovereignty assertions. State and municipal pension systems, including California Public Employees Retirement System and New York State Teachers Retirement System, face pressure when portfolio values decline through Canadian divestment, while recognizing similar vulnerability to international capital withdrawal that domestic pension obligations depend on for maintaining funding ratios and benefit payments. Corporate pension plans face funding crisis when market decline affects asset values that employers depend on for meeting pension obligations to retirees. While contribution requirements increase when Canadian capital withdrawal reduces investment returns, that corporate retirement promises depend on for financial sustainability without increased employer contributions. The institutional investor implications reveal how Canadian pension fund sovereignty validates similar investment-independent strategies for other sovereign wealth funds, public pension systems, and institutional investors seeking reduced exposure to American market volatility while serving domestic investment obligations that prioritize beneficiary interests over accommodation with American financial market preferences. Norwegian Government Pension Fund Global, managing over $1.4 trillion in sovereign wealth assets, observes Canadian success while evaluating similar investment sovereignty strategies that serve Norwegian retirement security rather than accommodation with American financial market preferences. European pension funds coordinate investment alternatives that reduce American market dependency. Asian sovereign wealth funds, including Singapore's GIC and Hong Kong Monetary Authority, observe Canadian pension fund success while recognizing opportunities for investment cooperation that serves regional economic development rather than American financial market accommodation. Chinese sovereign wealth funds gain validation for investment-independent strategies. Middle Eastern sovereign wealth funds, including Saudi Arabia's Public Investment Fund and UAE's Abu Dhabi Investment Authority, evaluate investment diversification strategies that reduce American market exposure, while Canadian pension fund success demonstrates investment sovereignty, feasibility, without compromising return objectives or fiduciary obligations to beneficiaries. The alternative investment implications demonstrate how Canadian pension fund sovereignty enables domestic and international investment opportunities that serve Canadian economic development while reducing dependence on American capital markets that might subordinate Canadian investment policy to external market preferences rather than serving Canadian retirement security and economic sovereignty requirements. Canadian infrastructure investment receives priority when pension funds redirect capital toward domestic projects, including renewable energy development, transportation systems, and telecommunications infrastructure that serve Canadian economic development while generating stable returns for pension beneficiaries. Domestic investment reduces American market dependency while supporting Canadian economic sovereignty. European investment partnerships, including cooperation with Dutch pension fund ABP, German pension systems, and French retirement institutions, provide Canadian pension funds with alternative investment opportunities that offer competitive returns with geopolitical stability guarantees. European real estate, infrastructure, and technology investments serve diversification objectives while reducing American market exposure. Asian investment opportunities, including partnerships with Japanese pension funds, Korean sovereign wealth initiatives, and Singapore infrastructure development, provide Canadian pension funds with growth market exposure that serves return objectives while reducing dependence on American financial market performance that diplomatic tensions might affect through investment relationship volatility. The financial technology and innovation implications reveal how Canadian pension fund sovereignty accelerates development of alternative investment platforms, portfolio management systems, and financial technology partnerships that serve Canadian institutional investor requirements while reducing dependence on American financial technology providers whose services might accommodate American regulatory preferences rather than Canadian investment sovereignty. Blockchain investment platforms developed through Canadian pension fund cooperation enable direct institutional investment in international opportunities without American financial intermediation, while providing transparency, security, and cost efficiency advantages that traditional investment management cannot match when serving Canadian pension fund requirements for investment sovereignty and fiduciary obligation fulfillment. Artificial intelligence portfolio management systems developed through Canadian institutional investor cooperation provide investment analysis, risk management, and return optimization capabilities that serve Canadian pension fund objectives, while reducing dependence on American investment management firms whose analysis might accommodate American market preferences, rather than Canadian pension fund fiduciary obligations. Digital asset management platforms enable Canadian pension fund investment in cryptocurrency, central bank digital currencies, and blockchain technology opportunities, while maintaining investment sovereignty that serves Canadian monetary policy objectives, rather than accommodation with American digital finance regulatory preferences that might conflict with Canadian pension fund investment strategies. The regulatory and governance implications demonstrate how Canadian pension fund sovereignty operates within established fiduciary frameworks, while asserting investment authority that serves Canadian retirement security rather than accommodation with American financial regulatory preferences that might subordinate Canadian pension obligations to external market accommodation requirements. Office of the Superintendent of Financial Institutions. Canada supports pension fund investment sovereignty while ensuring fiduciary obligation compliance that protects Canadian beneficiary interests rather than accommodating American financial regulatory preferences. Canadian pension regulation prioritizes domestic retirement security over international market accommodation when investment conflicts emerge. Provincial pension regulation, including Ontario Pension Oversight and Quebec Financial Services Regulation, supports institutional investor sovereignty while ensuring retirement security protection for Canadian beneficiaries. Pension Fund Investment Authority enables portfolio management that serves Canadian retirement obligations rather than external market accommodation that might compromise fiduciary duty fulfillment. Federal retirement security policy, including old age security and Canada Pension Plan integration, supports institutional investor independence while coordinating retirement income systems that serve Canadian retirement security rather than accommodation with American retirement system preferences that might not serve Canadian retiree income requirements adequately. The international regulatory cooperation implications show how Canadian pension fund sovereignty influences global institutional investor governance while providing precedent for investment independence that serves domestic retirement obligations rather than accommodation with dominant financial market preferences that might subordinate national retirement security to external market convenience. International pension fund associations observe Canadian investment sovereignty while evaluating governance frameworks that prioritize beneficiary interests over accommodation with dominant market preferences. Global institutional investor cooperation gains momentum when Canadian success demonstrates investment sovereignty advantages for retirement security and fiduciary obligation fulfillment. From Canada's perspective, pension fund investment represents legitimate investment sovereignty that serves Canadian retirement security, fiduciary obligations, and economic development rather than automatic accommodation with American financial market preferences that might subordinate Canadian pension obligations to external market demands that fail to serve Canadian retirement security adequately. Canadian pension fund fiduciary obligations require investment strategies that prioritize beneficiary interests over accommodation with external market preferences when diplomatic relationship deterioration affects investment security and return prospects. Investment sovereignty enables optimal portfolio management for Canadian retirement obligations rather than accommodation with American financial market convenience. But from Washington's perspective, Canadian pension fund withdrawal represents catastrophic capital market vulnerability that threatens American financial system stability, retirement security, and economic relationships through sovereignty assertions that American financial policy had not anticipated or prepared for through alternative capital attraction, institutional investor retention, or market stability frameworks adequate for maintaining capital flows. When institutional investment becomes conditional, American financial authorities prove inadequate when market stability depends on international capital flows. That sovereign institutional investors can redirect for legitimate fiduciary reasons, while domestic financial policy cannot replace international investment requirements for market liquidity that American retirement security depends on for maintaining asset values and investment returns. What Canada's pension fund divestment ultimately accomplishes is not financial warfare against American interests, but investment sovereignty assertion that requires American financial policy to account for Canadian institutional investor interests rather than assuming continued capital flows. Regardless of whether investment relationships serve mutual benefit or primarily American financial market convenience at Canadian investment sovereignty expense, this crisis represents both financial policy failure and strategic recognition opportunity for American capital market planning that must now account for institutional investor dependencies requiring respectful international cooperation rather than presumed capital access from sovereign investors whose cooperation cannot be assumed indefinitely when relationships fail to serve mutual investment interests through respectful partnership maintenance. The institutional memory of this investment sovereignty crisis will influence international capital market relationships for generations because it demonstrates how institutional investor dependencies can create financial vulnerabilities that market capabilities cannot address when sovereign pension funds exercise legitimate investment authority.